The markets continue to tread water. It is a quiet day once again as we continue this slow waking up from the Thanksgiving holiday for U.S. financial markets. But now comes the event risk. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive, and we are facing the first batch of what will be meaningful macro risk facing investors this week. So what we are going to do here is take a look exactly at what that is and attempt to unpack what it might do for financial markets all across the board. So not surprisingly here, what I am talking about is, of course, a speech from Fed Chair Jerome Powell that kicks us off. We are going to also get a bit of economic data, which we'll touch on as we go. But it's really this speech that captures the market's imagination here because, of course, we have a situation where the outlook for the Fed has been a dominant consideration for investors for much of the year. And of course, very clearly a driving source of the narrative for the past 2.5, 3 months. So what we'll do here first is we'll take a look at what all of that has looked like, and why the markets have done what they've done, and then consider what Powell could say to change the landscape, if anything at all, that is. So here is what the Fed rate cut cycle started with, which is really the essence of the most immediate part of this narrative, in September. This is the latest update to the Fed's forecasting for where rates are going. Note here, first and foremost, the outlook for 2024 is for rates to be at 4.4%. Now, this is, of course, the central tendency. You see that here. So don't get stuck on the specific number. The key here is the implied trajectory. And at this time, rates are at 5.3%, which is the effective medium or median between the 5.25 and 5.5 setting that is there before the cuts begin. So in saying that we're going to go from 5.3 to 4.4, what the Fed is saying is there will be 100 basis points or 1% in rate cuts this year. It does this as it delivers 50 of those basis points up front in September. That leaves 2 policy meetings and 50 basis points to meet the forecast. That's 25 basis points apiece. The Fed could not be clearer then in announcing this when they do, that the path for the rest of this year is pretty well set. They then look at next year and say, we're going to go from 4.4 to 3.4, meaning the following year is going to have another 100 basis points or 1% in rate cuts. This is where the markets look at what the Fed has said and go, right, okay, does this sound right? Does this sound reasonable? And of course, by then, they look at an economy that is beginning to show some steady signs of improvement. We see here that from late August, U.S. economic data starts to improve relative to expectations. And the economy starts looking increasingly strong. This is where the Fed meets, second half of September. By then, the market is already looking and saying, well, okay, they're going to cut 50 basis points. They're going to basically talk their way into 50 basis points more by the end of this year, and with only 2 meetings left, there's not a lot of discretion there, so that's probably a given. And they're telling us 100 basis points next year. But if the economy is getting warmer, how likely is that next 100 basis points? Well, if inflation goes up because they're cutting rates at a time when the economy isn't cooling, that probably means that whole 100 basis points won't happen. So what you see in markets then looks a bit like this. Here's where the Fed rate cut cycle starts. So you figure that 233 basis points here include 100 basis points for this year. Here it is. And another 130 basis points then for 2025. Here's the 50 basis point initial cut. That gets you over here. You then get a further cut of 25 basis points in November. And you are almost certainly looking at another one coming up in December. While this says that the likelihood is only 12 basis points here, this is a bit of a bit of an inaccuracy in the sense that what it tells you is the likelihood that you'll get a cut at some point in December. But if you were to actually line this up to when the meeting itself is occurring, that is the probability that there is a cut on the date of the meeting, well, that starts to look a lot more certain, 70-30 in favor. And so the cut there seems pretty much a done deal. As the Fed would have anticipated, then over here, that gives us 100 basis points in rate cuts, and at least that much seems uncontroversial. But look at what's happened for the rest of this. If of this 233 basis points, we can see right here, about 100 is a given and off the table now. 75 basis points done, another 25 basis points almost certainly in view in about a week and a half. That leaves 133 basis points here in rate cuts for 2025. That's in excess, by the way, of what the Fed's own forecast says, which is 100. In that time that the markets have assessed this against this improving economic data, what's happened is we've basically halved that and gone to about 60. So the markets have noted what the Fed did, interpreted it, and said, this means that you're not going to do all the rate cuts that you think you're going to do. And indeed, we can see this adjustment taking place over the past 2.5 or so months. This up here, these are inflation expectations implied in the bond market. They're break-even rates, so-called. They represent the adjustment that it takes to get from nominal yields, which is what you typically quote when you talk about just the Treasury bond yield, and real yields, which are TIPS yields on equivalent Treasury bonds that have been adjusted for inflation. If you take the difference in those yields, you get the inflation adjustment. So you get what the bond market expects inflation to be. In this case, we have the 5-year break even here, the 10-year break even here. You can see they've been rising, showing this increase in inflation expectations through September and basically going into now the middle of November. Only recently, only in the past maybe week and a half, 2 weeks, have we seen a bit of a backstep. So you can see here the markets are pricing out higher inflation. That's giving you higher yields. At the bottom here, we have the 2-year yield and the 10-year yield. So we have a parallel rise in yields across the curve. The dollar also rallies because, of course, higher yields give it a juicier yield advantage against other major currencies. And so with this, you get the sense that it's not really the December meeting that's controversial at this point. That much, again, seemed to be relatively baked in here. In fact, speaking after this September meeting at the press conference, Powell was asked where people should look for next steps, and uncharacteristically said, "Oh, just look at the summary of economic projections," which is not usually something that the Fed it goes out there to actively promote as a source of truth. It likes to instead say, "Oh, well, these are just our forecasts," and in any case, they're not group forecasts; they're policymakers' individual forecasts, and then we take a central tendency and a median. So this could vastly change. And in fact, if we look at the breakdown here, we can see that there was quite a bit of consensus around the call for 2024. Most policymakers felt pretty good about that 100 basis points. The dispersion for 2025 is much more subject to change. It tells you that there was a lot more diversity of views here. And indeed, we see that while the markets still clearly think the Fed is going to deliver on the 100 basis points that was promised for this year, the outlook for next year, much more so on the move as we get this readjustment. So really the question here is, will Powell say something when he speaks this week? He's due at the New York Times DealBook Summit tomorrow. Will he say something to keep this readjustment going? And the temptation might be to say, well, that yes, maybe he will. We have now had 4 consecutive months without disinflation. You can see here, looking at the breakdown for the consumer price index, the most recent update on inflation numbers that we have. And we can see here, most inflation lives in the service sector. It's generally gone from both energy and from the goods side, and the food side is relatively stable and small. Inflation at this point lives in core services. And over the past 4 months or so, it has stopped going down. It has either gone sideways or ticked up a little. And so what you have here then is the kind of thing that might get the Fed to go, well, maybe we don't need to cut as much. Maybe we don't need to do all of what we said. And were this to be novel, perhaps that would be market moving. But of course, the markets have been doing this already. And as we've heard from the Fed itself, it has generally agreed. In fact, Powell himself, in speaking after the November FOMC, seemed to acknowledge that the Fed doesn't need to run away with anything aggressive here, that things can happen incrementally and that they're not on autopilot. We heard the same sort of forceful repositioning in a speech just a week later, where he had a policy speech in Texas and talked about we are not on dovish autopilot. We are going to take it step by step. We still very much want to get to 2% inflation. And although we don't at this point seek to weigh down on economic activity any further, so we're in cutting mode, nothing is to say that we have to move at any given meeting, and we're going to be data dependent. So we've heard the pushback already. And the market has seemingly sniffed that out because, as we just alluded to moments ago, we can see inflation expectations have come back down. The dollar has pulled back a little bit. Now, of course, the trend moves here are very much intact. It's just that new momentum seems to be absent for now. In fact, bond yields have started to edge back. And so really the question here is not so much will Powell admit that the Fed was too dovish in September. He's already done so on multiple occasions, as have other policymakers. And indeed, November's cut, despite being a cut, carried a significant revision in the verbiage, as it were, that suggested the Fed needed to walk back some of its more overt dovishness. So how likely then is Powell to rock this boat? Is he going to say something that reiterates, perhaps with greater conviction, that the Fed is still very much minded on inflation, that the Fed is going to perhaps give markets reason to dilute rate cut expectations further beyond having them from basically 130 basis points to now 63 for next year? And the clues to the answer seem to show up in minutes from November's meeting, which have just come out. And the way that these meetings are recorded in the minutes is we get a kind of editorializing and then a sort of coded language that says how consensus a given view is. So it might refer to several policymakers thinking XYZ thing, some policymakers thinking something else. And then when you get a signal of, let's call it conviction, rather than referring to a few or even many policy makers, you might get reference to most. You might get reference to a large majority. You might get reference to almost all. And this is where I get some of these choice comments here that I've pulled out that I think give us a sense of where the consensus is. So first, almost all participants judged that the risks to achieving the committee's employment and inflation goals were roughly in balance, which is to say that despite inflation getting a little bit stuck on the way down over the past several months, policymakers still think that they're on track to get where they need to be going. Next, almost all participants judged that though month-to-month movements would remain volatile, incoming data generally remained consistent with inflation returning to 2%. This takes the point further and says, don't get stuck on volatility in the economic data. Which is to say, even though we might get some stickiness in inflation, even though we might get a wild swing in the jobs report, of course, we'll see how that goes with revisions this Friday, but October's jobs report at only 12K was a massive outside of consensus, outside of norms kind of number, which was very quickly written off as being a function of hurricanes and strikes, mainly at a company like Boeing. And so the Fed is very clearly saying here, don't over extrapolate any near-term twitch in the data this way or that. It gives you a consensus saying they are indeed still biased to cut. And then furthermore, a large majority of respondents had a modal expectation of a 25 basis point cut in November and December, which is to say that there really is no risk to the near-term December view, at least, as we've surmised here. All of which is to say, the Fed does not look primed to want to rock the boat, and the markets have already moved to take out half of the 2025 forecast. Which is to say, Powell probably has no reason to want to get any more assertive and is likely to say not much at all. At least not much that is new for investors. With that, you also get a piece of data seemingly following in a similar direction. The first bit of notable economic data also comes tomorrow. It'll come ahead of Powell by way of the service sector ISM report. The expectation here is we're going to cool down just a bit to 55.5 from 56. 56 in the previous numbers was, of course, the fastest pace of service sector growth that we have seen in over 2 years. The expectation here is that we're going to come back just a little bit from that and remain obviously at an economic setting that is quite robust. Now, we got the manufacturing side of this equation earlier this week. As we can see here, it's in contraction mode still, and as expected, below 50 on these PMI numbers means that sector activity is contracting. Above 50 means it's expanding, and the further you go in each direction is a indication of pace. So the further you go above 50, the faster the expansion. The further you go below 50, the faster the contraction. In this case, we were expecting a faster contraction in the manufacturing sector, 47.5. We got 48.4. So contraction, yes, but nominally better than expected. And indeed, if we take a look at the internals here, we can see that the price component actually came down. That's encouraging. Meanwhile, new orders grew for the first time basically since January, and employment shrank at the slowest pace since mid-year. So it's contraction, but the internals seem to suggest that there's some green shoots happening here, all of which is to say we're unlikely to get something that is tremendously negative out of the service sector side. It doesn't look like the economy more broadly looks to be hampered in some sort of way. Moreover, as we saw earlier here, U.S. economic data has tended to surprise on the upside, but maybe has started to see those economic models at the basis of the forecasting start to readjust for the disparity, which is to say, if the economy keeps beating expectations, at some point people need to revisit the expectations. Say, well, the economy is very plainly hotter than we thought. The model itself needs fixing. That typically gives you a period where the data starts to cool relative to expectations because the expectations themselves have increased. That may be happening here, or starting to happen, as we go through the 20-day or about a month-long moving average for this index. It tends to be about a month's worth of data that starts to get the dials turning on a model readjustment, because there's about a month's worth of a data cycle that analysts need to look through to get the conviction to do those things. So when you look at all of this, you get the sense that chances are you get a relatively supportive ISM, but probably not one that's a barn burner, probably not one that meaningfully changes policy expectations. And so if you get a relatively staid speech from Powell and a relatively benign ISM number that doesn't ultimately change the calculus, what you end up with is exactly the kind of stasis that allows a correction like this to continue, because the speculative narrative still looks to be out of fresh fodder. And if you've been riding these moves for the past 2.5, 3 months, maybe you're minded longer term, or maybe you're just looking for a tactical opportunity, and now the narrative on that tactical opportunity has been fully baked in, at least in its sort of initial phase, pending further evidence. And in the absence of that further evidence, maybe the dispersion continues and that tactical money continues to come out of the market, which is to say, you get a further pullback in the US dollar, a further pullback in yields, and a rise in bonds. And that's assuming neither Powell nor the ISM do much of anything at all. That is macro money for today. As ever, we are here right after overtime, Monday through Thursday. That's a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones for The Price of Truth tomorrow, back with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com. In fact, this very analysis will be there in written form today. I am also opining sporadically on the platform formerly known as Twitter and on Blue Sky at Ilya Spivak. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow.